snowball effect where the dollars you're moving forward from bill to bill to bill gets very, very large. And psychologically, to be able to pay off bills, even if it's just small ones at first, gives you just really positive excitement and energy, and gives you some momentum to keep going down that path.
There is a new American dream. One that doesn't involve working till you're 65 before you start enjoying life. If you're someone looking for ways to regain control over your time and check off that bucket list now, you're in the right place. We share tips from experts on investing, personal finance, and mindset so that you can finally have the freedom to work less and live more. This is the Freedom Investing Podcast with your host, Chris Toribio.
What's going on, everyone? This is Chris Toribio with the Freedom Investing Podcast, and I'm so happy you're here to join us for another amazing episode. If this is your first time tuning in, welcome to the show. Please make sure to hit the subscribe button so you can stay up to date with our latest episodes. Moving on to today's guest, we have Randy Smith. Randy currently resides in Peoria, Arizona with his wife, Jenny, and he spent the last 25 years working in various business development and leadership roles in corporate America. Randy started his real estate career doing out-of-state, single-family long-term rentals, and he quickly realized that many additional benefits he could receive by switching his strategy to passively investing in multifamily syndications. Randy has now invested in 18 different syndications with 8 different operators, which gives him unique knowledge and expertise to recognize a strong passive opportunity. Randy, welcome to the show, man. Before we dive into it, give us a quick 2-minute rundown of who you are, your background, and where you are in your journey to achieving time freedom.
Yeah, thanks so much, Chris. Super excited to be here with you. It's a fun journey to get to share with your audience and others alike. So, yeah, I think the intro that you gave was pretty comprehensive and gave a good idea of my background. But basically, I was a high-income W-2 guy for a number of years. And after we kind of got our financial house in order, we started investing in real estate like so many other folks do. And that led through a bunch of fun different journeys, kind of traveling out of state, investing in properties. And then ultimately, as you mentioned, we landed on passive investing and have just kind of taken off from there. We just absolutely fell in love with the passive investing space and am now doing that full time.
That's extremely exciting. And, we were talking right before the show today, and you had mentioned that you were recently able to get into a position where you were able to quit your W-2, which is a fantastic achievement. And I just want to congratulate you for that.
Yeah, thank you so much. And it's, to be transparent, it was one of those, it was a layoff situation, but fortunately, the time and energy and effort that I had put into real estate investing over the last handful of years, call it 5 or 6 years, put us in a position where I didn't have to go out there and look for another W-2 job right away. And in fact, with the monthly income that we have at this point, I won't ever likely have to go back to the W-2 just because of all of these amazing benefits we get from real estate investing.
That's amazing. And obviously to get yourself in the position where you don't have to immediately start looking for a job, and frankly, not even have to look for another one at all, hopefully, indefinitely. There was lots of planning that went into this, right? So talk to us a little bit about where you were when you first started this journey, what that looked like, how you got yourself set up as far as the foundation is concerned, and then talk to us about your real estate investing from there.
Yeah, so that's a really good question, and it kind of ties back to this foundational principle that I believe in, which is, get your house in order before you start real estate investing. A lot of people come in to real estate investing because they think they're going to get rich quick and they're going to come make a ton of money and then quit their job. But it really, if you come into real estate with your house in order, I think it gives you the ability to grow your real estate focus and your assets and your income from that asset much, much quicker than if you come in and you're carrying a boatload of debt with you, or you're playing the credit card game, or whatever that is. So, like many, many others out there, I came into corporate America and I had credit card debt and I had school loans. Like, I think we're going to see a lot more of that in coming years. And at the time, I knew that real estate investing was something that I wanted to do, but it seemed so far out of reach because I was literally living paycheck to paycheck, trying to make sure that the the bank account didn't reach zero before I got the next paycheck. So really, my wife and I, we spent a number of years actually following Dave Ramsey's baby steps, which is, well, for one, it's a difficult process. It's very different than what many people get used to from just pulling out the credit card and paying for everything. So we really had to change and adjust our lives to kind of meet the expectations and the steps of doing the baby steps. But fast forward a few years, when you get into a position where you're still making very, very good income, but you don't have all of the credit card debt and all of the school loans and all of the other challenges that come with bad financial planning, it really creates a freedom that allows you to just catapult your growth 10x at that point. And that was our experience.
That's amazing. And for our listeners who are not familiar with Dave Ramsey's baby steps, can you kind of highlight on a high level kind of what that entails?
Yeah, absolutely. So, and I might get some of these wrong. It's been a number of years since we've been there, but the first you hear Dave reference beans and rice, rice and beans, like basically taking your life down to the necessities and cutting out all of the frivolous spending and vacationing and restaurants and all of that stuff. So you're going to have to go through a little bit of pain because you haven't been disciplined with your finances up to this point. So baby step one is just accumulating $1,000 to have in the bank and just always keep those monies in the bank. And then he talks about taking everything that you make and putting it towards your debt and actually aligning your expenses from smallest to largest and start taking off the smallest one. And then at the end, you create this, it's been a lot of years since I've talked about this, but you create this snowball effect where the dollars you're moving forward from bill to bill to bill gets very, very large. And psychologically, to be able to pay off bills, even if it's just small ones at first, gives you just really positive excitement and energy, and gives you some momentum to keep going down that path. So from there, you start maxing out your 401ks and your other company sponsored benefits, and then it's just save like crazy, give like crazy, and ultimately pay off the house as well, which some people do, some people don't. And I will say that people have a lot of strong opinions about whether you should pay off your house or not. But sitting from my vantage point, there is no better feeling in the world than that day when you make that last mortgage payment and you know that your monthly expenses just went to, maybe a quarter of what they used to be. So it was an amazing, amazing experience for us. And it gave us the discipline and the financial footing to move into real estate investing with just a huge advantage over those other folks that are bringing a lot of debt into that arena.
I love that. And it kind of really goes to show that there's a million different ways to skin a cat. People have their opinions on Robert Kiyosaki's mindset. People have their opinions on Dave Ramsey's mindset. Anywhere in between. The point is getting yourself in a position of financial strength, setting that foundation so that way your risk tolerance is a little bit higher. So that way then you can take advantage of other opportunities that you wouldn't necessarily be able to take advantage of if you were busy paying off your debts on a month-to-month basis. So that's extremely powerful. And so when you get to this point now, your house is paid off, you're in a position of financial strength. Why real estate? How did you get started in real estate from there? What did that look like?
Yeah, so I think most people know that a large majority of very well off or financially people that have done very well with their finances have found some success with real estate. And my family was no different than the majority. And my dad actually did very, very well in real estate. He bought apartment complexes in LA County when I was young. So I got to sit on the sidelines and watch him doing that. He worked as a sheriff, so he didn't make a ton of money in his W-2 job, but because of the wherewithal that he had with his finances and with real estate, he was able to live an amazing life and provide for the family and do extravagant vacations and those types of things. So watching that on the sidelines, you know, compared to the lifestyle that my mom and my stepdad lived in, owning a small business, a restaurant, and living probably beyond their means, I got to compare and contrast, kind of a rich dad, poor dad type of scenario, and saw that living frugally and investing in real estate created amazing returns, whereas just working 80 hours a week and investing in a small business was maybe not the best idea. Um, so that seed was planted, but I always knew that I needed to get the financial house in order before I went down that path.
Absolutely. Yeah. And as someone who watched their parents kind of go down the path of small business, it's definitely not passive. There's a lot of hours
No.
spent growing the business. There's a lot of hours spent maintaining it, maintaining those relationships, working in it, especially takes a lot of time. And so for yourself, as you were mentioning, you have the benefits of real estate. You wanted to get active. What did that experience look like when you first made that jump into active real estate investing?
Yeah, so I sat on the sidelines for a lot of years. I was actually for the last 10 or so years of my career, I was in business to business, face to face sales, where I was traveling out of town from Tuesday through Thursday every other week, and I would just go from meeting to meeting, meeting with business clients. And because of that, I had a ton of windshield time, which meant that I'm driving, sitting in traffic, and listening to podcasts or books on CD or Audible, whatever at the time, I guess it was. And I just really dug into listening to all the great podcasts out there, reading all the great books that I'm sure all of your listeners know about. And I sat on the sideline though for quite a while because I didn't think that I had the bandwidth to take on a new activity. I lived in Phoenix where the market was on fire, so I didn't really think that I could invest there. And honestly, there was probably some fears around, if I jump into this space while I have my W-2, is my employer going to frown upon that? Are there, is it going to be viewed negatively as I'm trying to move up the corporate ladder? So all of those reasons essentially kept me on the sidelines much, much longer than I ever should have. And my advice to folks is not sit on the sidelines. But when I did finally make the decision to move forward, I made a decision on buying some turnkey properties in Kansas City, of all places. And that was driven by listening to a podcast, the Real Estate Radio Guys. And I heard a really, really energetic and excited sales guy talking about the turnkey opportunity in Kansas City. So got home, told the wife, and said, we're doing it. And we were all in.
I love it. So just to recap here. So at this point, you got yourself in a position of financial strength, right? You went through the baby step program with Dave Ramsey. You were able to pay off your house. You funded your 401k. You had savings. You've actually sat on the sidelines, but I'd imagine during that time you were doing some research, doing some networking, getting yourself prepared to finally make the jump into turnkey investing. And so at this point, did you pay, I guess, 20% down for these properties out of state? And why did you choose Kansas City out of all places?
Yeah, so you'll get this if you hang around me long enough. I'm kind of a ready, fire, aim type of guy. So sitting on the sidelines, I think I had the knowledge that I needed to make a good decision. At the time, I thought that anyways. And when I basically fell victim to the enthusiasm and energy and excitement from this sales guy that I heard on a podcast. And I had heard some folks talking about the Sun Belt. I had heard about turnkey before, and this just seemed like a great opportunity. And one mistake that I made is I assumed that since this individual was on a nationally broadcast and syndicated podcast and radio show, that he must be a good operator. So I jumped in and didn't do the due diligence that I should have, and moved forward with an operator that maybe I should have taken a look at some other operators first.
Oh, very interesting. So at this point now, so how many properties did you end up purchasing with this person before you realized this?
So I ended up buying two in rapid succession. So bought one, and then the next month bought another one. These are $100,000, $110,000 properties. So we're talking, $25,000 down. So it wasn't a huge risk, but still, without knowing what was about to come, I exposed myself to a lot of expenses that I wasn't necessarily prepared for, nor did I expect them to come, because I assumed with a turnkey property that I wouldn't have a lot of CapEx expenses in the first couple of years, and that ended up not being the case.
Absolutely. And real quick for our listeners, can you kind of describe real quick what a turnkey property actually is?
Yeah, so turnkey, like it sounds like it should be a turnkey investment, meaning you pay for it, you get the keys, turnkey, it's a business that's going to generate income. So in this specific business model, it was supposed to have been a property that he purchased, renovated, put a new tenant in, and then handed it over to his property management team. So in theory, I would pay the down payment, I would start getting a monthly check, and everything would be wonderful. Turnkey model in and of itself is a great model with the right operator. But if you end up partnering with an operator that doesn't do a good job on the renovations or puts bad tenants in there or has bad property management, that it can end up being a nightmare. So fortunately, with the two that we bought, we found out pretty quickly that this was not a path or a partnership that we wanted to continue to invest in. So we moved on to another strategy, doing the Burr strategy in Atlanta, which ended up being much more successful than those two. But fast forward a few years, we ended up selling those properties and making a decent amount of money on it, but nowhere near what we could have made had we did a little bit better due diligence and not had to incur all of those expenses on the front end.
Absolutely. And are you able to kind of disclose the experience that you had with these first two properties before you decided to execute the Burr strategy in a different market?
Yeah, so the purchases went fine. Purchase down payments, like I said, is probably 25 grand a piece down. Um, and you would think that everything would be fine and you'd move on, but we ended up having to replace a roof just within like 60 days. We had a major plumbing problem that just seemed to never go away. So it was, nickel and dimed by the property manager. It seemed like every month there was another two, three, five, $800 bill that was coming from something. And probably the biggest mistake that we made through that whole process um, was when we came down to the purchase and you go through the inspection period. His advice to us was some people will choose to go through an inspection, but I've already inspected these and I'll let you review our inspection reports, of which we did. And I thought he was an expert. And as it turns out, I should have spent the money to have the inspection by a third party because they would have saw very quickly that there was a ton of work that needed to be done on these properties. So that was probably the biggest mistake that I made.
Very interesting. And so moving forward from there, you went ahead and went into the Atlanta market. Sounds like you executed the Burr strategy on these. What did that kind of look like? And how did you do this again from a distance, living in Peoria,
Yeah.
Arizona, and investing completely across the country? How did you kind of develop the teams and systems in place to make sure that you were successful this time around?
Yeah. So it was, ultimately to do the Burr strategy, you need to have a realtor on your side. You need to have a construction guy to do the repairs, and then you need to have a good property management. So it comes down to the teams and the systems that those teams use, whether you're going to be successful or not. So at that time, my wife had actually left her W-2 and she started working on some other projects, but she had some bandwidth to do the research and start building those relationships from afar. And I think we had purchased our first property before we actually flew to market. So my wife was able to establish a relationship with a realtor that was really just working very, very hard to try to find us properties. Found a fantastic property manager and she interviewed them, just did a really, really great job. And she had done a lot of research on how do you vet realtors, how do you vet property managers, how do you vet construction folks, and come up with scope of work. So she did a really, really great job finding that team, which ultimately led to us buying a handful of properties out there and creating just a ton of capital in a fairly short amount of time. Within 2 or 3 years, I think we generated 350 grand in equity out of those properties.
Yeah, that's definitely the principle of the Burst strategy for sure, is really being able to get yourself in a position where you're essentially recycling a lot of the same funds, right? So for those who don't know, the Burst strategy is an acronym as well, and it stands for buy, rehab, rent, refinance, and repeat. So you buy a distressed property, you renovate it, you improve it, and then you put a renter in there to help start paying down that mortgage. At that point, because you did the renovations, the value of that property goes up at a much higher rate than hopefully what you put into it. and you're able to refinance, get all of that capital back that you invested, and use that to repeat it on another property. And so, what Randy was referring to here in terms of building his team in this market is what many people refer to as the core four, which is typically your realtor, as you were saying, a lender that lends in that area that's investor friendly, a property manager, and typically a contractor as well. And once you're able to find a really rock star team comprised of all those core four people, it'll really set you up for success, even if you're going to be investing long term, so long distance. So that's incredible. And so, Randy, talk to us a little bit about what that looked like, managing it from a distance, as well as how many projects did you undergo before you started investing passively?
Yeah, so we actually, let's see here. Our first one was probably our biggest home run that we did, but we ultimately ended up scaling to four, or we purchased four actually in Atlanta. One ended up being a bad purchase that we ended up getting out of, or actually selling real quickly. But the other three, we did very well with those.
Fantastic. And so you went about doing these four projects and then finally decided, look, let's consider investing passively into syndications. I guess what made you kind of shift your mindset to think, well, I don't necessarily have to be active. Maybe investing passively may be the better option for us.
Yeah. So what we found is that BRRRR strategy is a really great way to create equity in properties, but it's not always the best way to create monthly cash flow. So imagine you have, you buy a property for 50 grand, you put 50 grand into it, and then it appraises for 200. You think, fantastic, we just made $100,000 on that property. But if you're only cash flowing $100 a month on that property, or two, or even 300, you've got quite a bit of money, quite a amount of equity tied up in that property that you can't pull out, and it's only earning you a very small return. So return on equity starts to become a more and more important equation or statistic to take a look at. So, we had all this money tied up in these properties, and then in combination with that, the market was just on fire. So it was extremely hard to find more properties that would actually fit the model. So we just made the decision to shift directions. And I think what a lot of people in the single family space, at some point, you will come to this realization where you'll do the calculation and find out, like, how many of these homes will I need to do in order to hit my freedom number. And for us, it was probably 100 plus properties. And the thought of going through everything we went for those 5 properties or 6 properties, a total of 100 times, was a little overwhelming. So we decided to shift gears and try to scale faster. And the initial thought was going into multifamily, and we started looking at small multis, I would say medium multis, so not the 1 to 4. We were looking in the under 20 range. And I had an awareness at the time that I was probably not skilled enough to take those down and to take on the responsibility, because at the end of the day, I made very, very good money in my W-2, and every minute that was taken away from that was taking the opportunity to continue to make those dollars more and more and more. So we decided to shift over to passive, and the passive journey has been just amazing up to this point. We have been able to shift capital into that market fairly easily after we learned how to vet operators. And we started seeing returns just immediately that were the same or better than what we were getting by investing into single family space.
I love that. We had another guest on our show a few weeks ago. His name's Nir Wittenberg, and he was a high paid tech professional. And he encountered the same realization as you did, where he said, well, I'm spending all this time. He was doing wholesaling and single family fix and flips, but similar concept, right? You spend all of this time finding properties, underwriting the properties to see if they're viable opportunities, bringing on contractors, managing rehabs, putting a tenant in there, and then going through this entire process. And you realize at the end of it, you still have one deal. Yes, you may have cashed out a ton of equity, but you still have some equity trapped in there to the point where you're only making maybe anywhere from $100 to $300 a month. Some point you're like, well, that didn't really push the needle forward in terms of freeing up my time, right? And so I would encourage anyone looking to jump into the real estate space to really take inventory of what it is you actually want out of life, right? Are you in a position where you don't need the cash for right now? You're okay using this as an alternative method to the stock market to invest in, and you're okay with those delayed returns? Or are you actively looking to replace the income from your job? And if that's the case, you have to kind of figure out what type of strategy it is that you're going to be doing, because there's a million different ways to make money in real estate. It's just a
Yeah.
matter of which type works best for you. And so when you're started investing in syndications, it looks like you invested in 18 so far with 8 different operators. And so
Yeah.
there's obviously a lot of experience, as you said, vetting the operators. That's the most important thing. So talk to us a little bit about how your first experience went and then what you kind of learned from there.
Yeah, thank you. And good question. And Near, by the way, I know Near fairly well. Really great guy in the space too. So for your listeners, definitely reach out to him and connect with him. But yeah, so the passive investing space, that first investment that I did, as I mentioned, I had listened to Bigger Pockets and a lot of different podcasts for years and years and years. So I knew, liked, and trusted a lot of the people that I was listening to, and some of the podcasts that actually are very large brands at this point. They've got large organizations behind them. Some of the individuals that are actually leading the way, or their personalities, have their own side businesses as well. And I made the decision to invest with one of those operators for my first passive investment because I'd been listening to the guy for 3 or 4 years. I felt like I knew him and his family. I knew, like, literally, probably, potentially hundreds of hours listening to this guy over the years. So I felt very comfortable with what he was doing. Our morals and values seemed to align very well. And he had created an amazing company. So I made the decision to invest in his fund. Now, my initial investment was the minimum investment. I know today that you can ask to do less than the minimum investment as a passive investor. So knowing that, it would have probably made more sense for me to invest less with one operator, because I think diversification, just like in any investment, makes a lot of sense and should be part of your strategy with passive investing as well. So nonetheless, I chose to invest in this. We've done very well with it. He's paid his distributions quarterly for the last couple of years. Really great communication. It's just overall been a fantastic experience. And that early experience that I had with him gave me the confidence to jump in and invest with the next person. So I started this routine where I would vet an operator for a handful of months. I would invest with them, wait to see what the communication looks like, and make sure I'm starting to get distributions the whole time, starting to vet the next operator, because I want to spread my money across not only separate deals, but multiple operators, multiple asset classes, multiple geographies as well. So, like anything, there's a couple of different schools of thought there. Either put all your eggs in one basket and watch the basket very closely, or spread it among many baskets. And I'm of the mindset that I want to spread it among many baskets and watch them as closely as I can as well.
I love that. And as you said, it gives you the opportunity to invest in multiple asset classes within the real estate asset space. So that's
Yeah.
a really good opportunity there. And so when you're vetting an operator, as you said, you follow them for a little bit, but what other things you purposely take into consideration before you decide, hey, this is someone that I really want to invest my money with, and I think that I'll be able to grow with their company?
Yeah, so I think the best indication of future success is past success. Past success. So I generally like to invest with operators that have a track record, that have been doing this for years, that have experience of doing the entire business model that they are suggesting for the current opportunities. So in the multifamily space, specifically in the value add space, which is where I focus most of my dollars, I want to see operators that have bought properties, renovated properties, re-tenanted, raised rents, and then sold in some time period. Most will present that they're going to do that in a 2 to 5 year period. So I like to see how quickly are they doing it, how many have they done, and what type of results have they got. Because anybody can put together a deck that'll tell you they're going to give you 16 to 20% IRR and 5 to 8% cash on cash. But if you don't have any experience doing that, I don't have any confidence that you can actually do that until you show that you have. So there's plenty of operators out there that have done this. So I'm going to put my dollars with an operator that has the experience versus giving my dollars to the guys to go out there and try to train and prove that they can do it. So
I love that. Absolutely. So past success indicates future success, right? And so being able to take advantage of knowing what their track record is. And as you're saying, projections are just projections, right? So you can put a really novice operator in that place and say, well, we're making these projections and they could very well be a perfectly good deal on a spreadsheet. But when it comes to actually operating and executing the business plan, some novice operators can completely turn a great deal upside down. On the other hand, someone who's been experienced may be able to potentially take a deal that may seem a little bit tight on paper, but really make it a absolute, home run by the time that hold period is over. So that's a great point for our investors who are interested in passively investing. And I think really people should take these type of things into consideration before they jump, because their marketing techniques are very good, or their pitch deck looks really, really nice, or their return projections seem really good. This is the true way to really vet an operator. And so, Randy, at this point in time now, you're invested passively into syndications. What does it look like for you now? What does your time, how do you spend your days, now that you no longer have a W-2 to necessarily have to go back to? What is your goal moving forward from here?
Yeah, so at this point, after leaving the W-2, I've started to move back into the active space. So I am helping connect investors with great investment opportunities at this point. I formed a business shortly after leaving the W-2 called Impact Equity. And our goal is to educate and inspire the new passive investor. Because I believe that once the W-2 investor finds all of the benefits of investing in real estate through passive investment in syndications, I think you can very quickly find the path to time freedom that you guys talk about and everybody's searching for. So really, the goal now is just educate and inspire new passive investors and help introduce new traditional investors to the passive investing space.
Love that. Love that. All right, folks. Well, we're coming towards the end of today's show, but before we finish, it is time for the Freedom 5. These are 5 questions that we ask every guest on our show, starting with the most important question: what is your why? What is the underlying motivation behind everything it is that you do?
Yeah, so mine is kind of twofold. Of course, it's family and making sure that I create a good financial future, not only for my wife and I and my kids, but also for our parents who have worked their butts off their whole lives, but never found the financial security that we would hope to have for ourselves. So really taking care of our family, both our children and our parents, is really number one priority. Second is contribution. Contribution is, for me, when I have the ability to help people, that's what gets the juices flowing. That's what makes me feel the best. That's what makes me run out of the office and high five my wife. So, yes, let's take care of us financially, but I really want to try to help others do the same as well.
Love that. Number 2, what book has had the largest influence on your life, other than Rich Dad Poor Dad, of course?
I like that you throw that in. So one book in the last couple of years that's really had a big impact for me is Who Not How. I'm a really, really big fan of Benjamin Hardy and Dan Sullivan. All of the books that they put out there are just fantastic. But Who Not How is a book that's really helped me dig in to figure out, like, what is my superpower, and focus on my superpower, and then give others the ability to focus on their superpower for things that I just, quite frankly, don't want to do. So finding ways to focus on the things that I'm best at, and everything else, find somebody else that could be an expert. So it's been really, really powerful for me in my journey.
Love that. Yeah, it's so important to be able to have that realization that you don't have to be an expert at everything. You don't need to know everything. You don't need to do everything. Sometimes it's just a matter of realizing, well, I'm really good at this. And then all these other things that you have to do that are still responsibilities, you can leverage the time and expertise of others to get things done in a better way than you would have done if you try and do it yourself.
Absolutely.
Number 3, what is the most impactful thing, whether it's a piece of technology, a habit, or a person, that has helped in freeing up your time?
So I hate to go back to that same book, but it is that book. We spend so much time. Like I remember, I used to take really, really great pride in doing my yard work, and I think it was because I watched my stepdad for years and years. He would spend the whole weekend doing that, and then you'd come in, he'd be exhausted and just crash into the couch. So today, I actually just choose to pay somebody to do all of those things that I don't like to do, and I'm not ashamed to say we got a housekeeper. We got somebody that does the pool. We got somebody that does the yard. I hire people to do all the things that I don't want to do, which frees up my time to really focus on the stuff that I want to. So
I love it. And even if that means spending a couple extra hours with your loved ones, I mean, that's priceless,
absolutely.
right? So
Absolutely.
that's great.
Yep.
All right, number 4, what is your number one piece of advice you would give to anyone else looking to achieve more control over their time?
Yeah. So I think from experience, I think just simply taking action. And, Brandon Turner gives this really great analogy where he talks about like, you don't need to know every step of the way. You just need to know the next step. And he uses the analogy of driving on a foggy day. You can only see the next 50 feet in front of you. And, you can allow yourself to get all hung up on all the fears and the naysayers and everybody telling you a million reasons why you can't do it. But if you can see what the next step is, take the next step. And once you take the next step, you'll see what the next step is. And before you know it, you'll be well on your path. And don't spend 5 years driving around, other cities with windshield time, listening to podcasts and books. When you hear the same thing over and over and over and over again, just take the action. You probably already know what you should be doing next. And I would just encourage you, take that action today.
I love that. And that analogy really hit home as well. They also have a saying here, it's indecision is a decision because it costs you time. It also costs you opportunity, right? So if you are in a position where you know what you need to do, and for whatever reason you are having difficulty taking action, sometimes you have to sit back and think, well, if I don't do this, what will that cost me? Right. I always, as you said, your why is your family, being able to spend time with your children, being able to spend time with your loved ones. The same is for us. And a lot of times if I'm feeling in a position where I'm fearful of moving forward or taking action because of the potential risk that's involved, sometimes I find myself thinking, well, like, what could this mean for my future children if I take action now? And if I'm successful with this, what difference in the life of my future children could this make? And that has been such a huge driving force in making sure that we consistently get comfortable feeling uncomfortable, right? Just
Yep.
keep doing it.
Yeah, absolutely.
All right, Randy, 5th and final question we have here. What is the best way for our listeners to get in contact with you?
So probably the easiest way is just to find me on LinkedIn under Randy Smith. But I do have a website, impactequity.net. And for those folks that are interested in passive investing, I've got a great freebie in the lower left-hand corner. You can put your your name and your email address. And I've got top 10 questions to ask a syndicator before investing with them. So
perfect. Well, Randy, lots of really great information today. I really talked about how you made that jump from the W-2, set yourself up with a really strong financial position through the Dave Ramsey's baby steps. I also liked how you talked about your experience with active investing, both through turnkey as well as out-of-state BRRRRs. And finally, I liked how you talked about your transition into passive investing, what it looked like from your experience standpoint, as well as vetting other operators, so that way you can make sure that your money is well diversified and continues to grow. I just want to thank you again for being a fantastic guest and really look forward to remaining in touch.
awesome. Thanks so much, Chris. I appreciate it.
Now, if you like this show and want to learn more about how we can help you free up your time through passive real estate investments, check out www.freedominvesting.com. Make sure to subscribe to our monthly newsletter and schedule an introductory call with our team. We also have a free 7-day course on what passive real estate investing is and how to get started so that you can start your journey towards earning back more time in your life. To all of our amazing listeners here on the Freedom Investing Podcast, my name is Chris Rubio. Till next time.